PayPal and the Buffett Indicator. We're going to talk about both today on Open Interest. Hello, everybody. I'm Mike Coe. Welcome to Open Mic. Now, last week on Office Hours, we discussed PayPal with Professor Mark Guthner of Rutgers, a stock he likes at these levels. If you didn't happen to watch that live stream during trading hours on Tuesday, here's what I had to say. You get a situation like this. This is my thinking, because it does seem so cheap. So when I say cheap, what am I looking at? I'm looking at cash flow, right? So this company has a lot of free cash flow, expected to do more than probably something in the neighborhood of $6.2 billion in free cash flow this year, and has no net debt. So I can't help but think, does an activist begin to play in here? Does another company look at the business and think maybe this is interesting? And if it does, that would, of course, create a situation where the stock snaps to some new level when that news is announced.
Yeah.
Okay, so hopefully you guys heard what I had to say there, because I didn't come back through my IFB. The gist of it was this. I was just commenting that the valuation of PayPal had gotten so cheap that it struck me as likely that the company was going to start appearing on the radar either of activists or of others within the space. As of now, Bloomberg is reporting that PayPal Holdings is attracting takeover interest from potential buyers after a stock slide wiped out almost half of its value, according to people familiar with the matter. And if you take a look at my screen right now, you can see how PayPal shares have done since we discussed it on Office Hours last week. So I was making those comments at about 2:23 on Tuesday. You can see the stock's up about 8% or so since Tuesday's close. I point this out because I don't really think that 8%, although that's obviously a nice bump, and if people manage to buy the stock before that, I think that's obviously very nice. But I don't think 8% is really that material in the context of PayPal's valuations. So, if one was so inclined, and you can go back and watch that, it's on the Open Interest YouTube channel. You can see that even now it's still trading quite cheaply, even despite, 8-9% discounts, 8 or 9% a pop in the share price really isn't going to make a huge difference when the stock is trading as cheaply as this is right now. And actually, let's just take a quick peek. So versus full year anticipated earnings. Yeah, even now it's trading at less than 8 times next year's numbers. And we can also see that, assuming that the street's expectations for free cash flow are accurate, that you're looking at a very handsome yield in the neighborhood of, 15% or so? Better than that, 15.5% free cash flow yield. So that does provide a little bit of runway for somebody to turn that situation around. It doesn't surprise me, obviously, that some might be contemplating doing that. So now the next thing I wanted to talk about was this. So for the past several months, many have pointed to the U.S. stock market capitalization to GDP ratio, which is also known as the Buffett Indicator, as evidence that equities might potentially be overvalued. And I was not really familiar with currentmarketvaluation.com, but I came across this as I was, looking into this topic today. So, I don't have any relationship with them. They do offer a paid annual subscription that I think is like $99, but the slides that I'm about to show you now, I got off of their website for free. So again, not a recommendation to use their service or not, but I think the way they represent these things is both interesting. It helps provide some context. They're capturing an important element here, including this historical trend line. But basically what we're looking at here is a measure of all of the U.S. stock market, which I guess most people, and I'm not sure this is what they are looking at, but most people who are looking at this will look at something like the Wilshire 5000 as a proxy for all the U.S. publicly traded equities, and comparing the market capitalization of those businesses to U.S. GDP, which at the moment is about $31.5 trillion. Now, what is interesting is that the top 5 largest publicly traded U.S. companies today have a combined market capitalization of about $17.5 trillion. It was actually higher than that as of Friday's close. I'm not sure exactly where it is now. It's obviously a little bit lower. The market got hit a little bit today. That's approximately, at least in nominal terms, what U.S. GDP was 12 years ago. And in fact, if you take the combined market capitalization of the top 25 companies in the S&P 500 right now, that exceeds GDP at the moment. That's about $32 trillion. And what's interesting here is that the fact that there's any trend at all, which if you're looking at this chart, you can see that's the gray line right, or the gray hash line. That's this part right here. So that's sort of, it's hard to tell, but that's kind of the trend line for the relationship between the value of publicly traded equities and U.S. GDP. It suggests that there is a dynamic at work here that a simplistic ratio doesn't quite capture. And so for us to really establish whether it's as extreme as it might sound, or certainly as extreme as it looks from this chart at least, we have to think about what some of the potential drivers of the trend are and figure out whether possibly some of those trend drivers simply have accelerated recently, and that justifies a migration of the value of publicly traded equities to GDP. One of the things that people have spoken to is globalization, right? So as you know, over the course of time, U.S. companies have become increasingly multinational, and J.P. Morgan notes that the S&P 500 generates now somewhere between 28 and 30% of their sales overseas, and the tech sector, which is the fastest growing recently, is much, much higher, probably north of 50%. I would offer that a counterpoint, or a partial counterpoint at least, is that while it's true that U.S. companies are selling more abroad, it is also true that U.S. consumers are purchasing significantly more from abroad than they once did as a part of globalization as well, particularly imported goods from China, for example. If we go back to 1980 or so, which we can see is about the low point. And I think that low point in 1980 is important for another reason. We're going to get to that. Another potential reason why you would see this expand is that the companies, the largest companies in the S&P at this point, are very asset-light, high-margin businesses. You take a look at the margins that NVDA achieves, the largest company. We've really never seen anything quite like it before. We're talking about net income margins, net of taxes, that are north of 50%. This is remarkable. A lot of these businesses have their value tied to intangibles such as software, intellectual property, networks, and the margins can be structurally much, much higher than they would be in traditional, old, more industrial economy type businesses. Now, I would also point out, though, and this is why this 1980 number in particular is of some importance to me, is that rates also matter, right? So as rates decline, two things happen. One, the net present value of future cash flows goes up. And secondly, the cost of capital could indeed be going down, also the cost of borrowing for consumers and so on. So you can have lower rates increasing valuations just by themselves, but lower rates also stimulating faster growth. And all of that is a good thing up to and until they do that a little bit too aggressively, and suddenly you find that the Faustian bargain of money printing starts to create inflation, and you reverse a 40-year downtrend in rates, which is exactly what we did in 2022. We broke the 4-decade-long decline in interest rates definitively at that time, and I don't think we should anticipate that we are going to now return to a ZIRP policy. So as we take a look at this, We can try to take a look at valuations in other ways as well. So let me see if I can. So this is a 10-year PE ratio. So we can sort of compare these numbers to where they were. You can see that it's not as high as it ever was. That basically gets back to, this is the Robert Shiller approach. So the cyclically adjusted PE ratio, where you take 10-year history and you can basically say that, this is sort of right in the middle. It's very cheap when you're below that line, and maybe it's getting more expensive when it's above it. Bearing in mind that, I have a number of people that I respect tremendously who feel that equities just were not appropriately valued for a long time and should be higher than their historic average. Could be. But I still think some context is necessary. We're not as high as we've ever been, but we're not far from it. Here's another way to look at it, price to sales. Now we are at all-time highs. But this also goes a little bit to what I was just talking about. NVIDIA with net income margins of 55 whatever percent, you are going to see that because most of a dollar's worth of revenues turn into profits. So in that kind of a landscape, then you would expect to see things look a little bit more extended. This is the S&P value relative to interest rates. So as we just talked about, you can see that there would need to be a relationship between rates and the price for stocks. Another way to think about this is also looking at earnings yields versus the 10-year Treasury yield. You can see that there's a relationship here. It would certainly seem that better opportunities to buy stocks for sure are when you see earnings yields materially exceeding the 10-year yield. And it has done so on a couple different occasions, but you can see that back in 1980, that certainly would have be a buying signal. But then, of course, it also would have been here. Would that have turned out so well? Perhaps not. But I think these are important things for us to think about. And so I thought I would bring them up. Let me see. Do I have any more slides? That is it. So, again, I got these slides from currentmarketvaluation.com. And you can just go to that website and you will locate that information there. I have this chart up as well. I brought this one up because I was being asked earlier today whether I saw anything meaningful on the horizon with respect to volatility that suggested that there might be a catalyst for the week ended March 27th. And so I'm just going to do this. So if we're looking, is this it? SPX? Yeah, there we go. Okay. So I realize this doesn't look like a whole lot, but one quick observation I would just have people make is that if you take a look at the weekly term structure, you generally get this sort of upward slope, right? And so that is fairly consistent. So these dots that you're seeing here, the highs, each of these local highs, these are the Friday expirations for each of those respective weeks. So the only point I would make is that it doesn't seem to me like there's something in March that is inconsistent with that. If I tried to draw, I did a very bad job of that, but if I was trying to draw a smooth curve through all of those Fridays, I would get something that doesn't stick out too much as far as I'm concerned for March 27th. One of the things I would just point out, if you're thinking, well, why would volatility be higher, implied volatility be higher at the end of the week than it would be for the beginning of the week? Is there anything that we can point to that would give us some intuition why that might be true? Well, Wednesday, Thursday, Friday, perhaps more meaningful economic releases, things like the jobs data, stuff like that might be coming out. There are other reasons as well, but I just figured I would point that out, that this was something that I was being asked about. Why was I being asked about it? Because the VIX was up, when I looked at this earlier, we'll see where it is right now, it was up about 2.5 points today, ended up 2. In general, when we look at the VIX, we expect it to rise. This is just a heuristic, sort of a rule of thumb thing. If the S&P falls by 1%, then you might expect the VIX to go up by 1 point. Remember that the VIX is actually a percentage. It's basically a weighted implied volatility for the SPX going out 1 month. Why would this be true? Why would implied volatility rise if the S&P falls? And the reason is that even if nothing changed, even if options prices don't change, what's actually happening is the perspective of the VIX calculation itself is changing. And what I mean by that is that it is simply a forecast of volatility based on a strip of options that expire in 30 days. And so today being the 23rd, why don't we go out to March 24th? I'm going to get rid of this one. And we'll just take a look at strikes. So like this. So you're basically just looking out 30 days and you're taking all of the options for which there is a bid. So all of these downside puts and all of those upside calls, you can see the strikes down there. And then you come up with a weighted average. And that's all that the VIX is. Now, this is on a fixed strike basis. So you can imagine that if I'm observing, for the sake of argument, let's just say on a given trading day, let's just say this is actually not the case because it's actually going to be a wider strip of options, but this is for just illustrative purposes. If I'm calculating a weighted average right here, okay, so that it incorporates all of these strikes that I've just outlined, and the S&P drops by 1%. Well, 1% is going to be 68 points. All right, so this 68 points from 84, that's going to take me way, way, way in this direction, right? Because you'll notice down here, these are the strikes, so 67.50 and so on. So now, instead of being over here at 68.40, my universe that I'm going to be centered around is going to be closer to 67.80. So instead, I'm actually going to be looking and calculating the average for these strikes, right? And so you can see that simply by the market going down, even if implied volatility didn't shift for each of those options individually, I'm just looking at lower strikes, which are going to have higher implied volatilities as a function of skew. The other thing that can drive them, though, so if it's down 1%, and how much was the S&P down? Let's see. We'll double check. SPX was... So it was down just a little over 1%. And as I pointed out, the VIX is up almost 2 points. So where did the rest of that difference come from? Well, the rest of that difference actually came from that shift. So this white line that we have here that I just highlighted, that's where we are today. And the red line is where we were 1 business day ago. So this is as of Friday's close. So the red line, Friday, the white line today. So 1, I'm looking at a different set of strikes. You can see that. This is the segment in white. So it's lower strikes. So they're, of course, going to have a higher average volatility, weighted average volatility, than the higher strikes do. But also you can see from the strikes that we have in common, that's these, that in fact volatility did shift up. And it shifted up by about 0.9. Now let's go back to the VIX index. What did we get? The VIX was up 1.9. So the S&P is down about 1%. Vol shifted up about 0.9. There's your answer. Somebody happened to ask about that. Thought that might be of some interest to all of you as well. Okay, so with that, I figured we would move on a little bit and see if we have some questions to answer. KJ Lemur, so hi to you. Steve Garcia, so if one is to believe the Buffett Indicator mean regression tendency, how do investors change their portfolio? More global EEM, less U.S. equities, more or less gold, etc.? Excellent, excellent question. So, a couple things to think about. First is, just because the aggregate of U.S. equities has increased so materially relative to U.S. GDP does not mean that every single stock has gotten overvalued or expensive. In fact, we just talked about one that doesn't seem to be terribly expensive in the form of PayPal. as I also pointed out, the top 5 companies in the S&P are more than half of U.S. GDP right now, about 17.5 trillion. So we're talking about NVIDIA, Alphabet, Amazon, Apple, Meta. Actually, I got one of those is out of order because I didn't mention Microsoft. But just the top 5 are more than half the economy. The top 25 are the size of all of the economy. So if there's thousands of stocks, and there are, and you sort of took those out of the mix, are the remaining companies exceptionally expensive? And not all of them are. So that's one of the things you can do. You can look to sectors that haven't performed so well recently that have gotten much cheaper. Healthcare would be a notable example. Maybe energy. And banking is reasonably valued, I would say. The financials are reasonably valued. Gold, actually, it's interesting you bring up gold because Bloomberg's research they came out with something and indicated that when you have market corrections, that gold can be a non-correlated buffer to have in your portfolio. And generally, I think that's true. And I recommend that people have precious metals in their portfolio as a sort of a non-correlated sleeve and a bit of an inflation buffer. The only thing I would say about it, though, is that that's a sector that has done so phenomenally well over the last couple of years that if the logic is I'm looking for ways to mitigate reversion to the mean as a function of relative outperformance, how does one square that with the fact that the precious metals are one of the things that have so materially outperformed? So I'm not sure that I definitively have an answer. I would suggest, though, that adding more to gold after such a run as we've had, to me, that doesn't make quite as much sense as positioning more into healthcare, positioning more into energy, maybe a bit into financials. Staples have come pretty far. So that might not necessarily be the place that I would go piling into, but utilities, I think, remain okay. So that's one of the things I would certainly think about. It is also true that foreign stocks are, in many cases, much less expensive than U.S. stocks are. This is generally true for Europe, but Europe also has slower economic growth, and they don't necessarily seem to be hopping on the bandwagon of doing the kinds of things that are going to stimulate faster growth. So I think that that as an area, as a region, we should expect it to trade at a discount to the United States. It does. It consistently does. It deserves to. Emerging markets might be an interesting place to play as well. So I do like that idea. India, I think, is interesting. And we've actually seen some good performance from some other areas. One of the things, because we haven't had a chance to talk about this, but if we go to sort of a flat tariff world, which is because we had the Supreme Court ruling, I think, since the last time we did one of these, a 10% flat tariff around the world would, of course, be beneficial to those countries that, under the more, agreement by agreement arrangement had much higher tariff rates, like China. I've also seen that Brazil would be a potential beneficiary. 10% is kind of where we landed with some of these other countries, so it's not really going to have much of a difference for places like Japan. It's not going to have a huge difference for a lot of countries in Europe, but I think that's an important consideration as well. KJ Lemur says 1.2%. Not sure what you're referring to there. I guess you were just responding probably to my just looking up what the drop in the S&P was today. So I'm guessing that's probably what you were looking at. Anil, what do you think of a diagonal 170-180 put March 20th to April 17th spread on NVIDIA looking to earnings on Wednesday? Long 170, short, let's see, what are you thinking? Short the 170s for March, long the 180s for April? Do me a favor, Anil, if you could, and just let me know which way you have that around. I'll look at both, but I'm curious the way you're looking at this. And Why don't we just pull this one up, I guess, in options play. We'll look at it that way first. KJ, thank you. It was in relation to the drop in the S. Okay. I am honestly just baffled by why this is never right. So let's try that. All right, I guess that's it. Yeah, at some point it saved a bad password in there. Short one, okay, Anil, thank you. So short the 170s in March, long 180s for April. Let's have a peek. Well, let's actually start with this, okay? So before I even get that far, let's take a quick peek at what the vol surface is showing. So I was actually looking at this earlier today. Doubt many or any of you managed to catch this. I happened to be on New York Stock Exchange television right off the opening bell this morning, probably around 9:35 Eastern time or thereabouts. I was being asked about this. The implied move for NVIDIA is not huge going into the print, although it looks a little bit bigger now than it did when I was looking at that. I had calculated the one-day implied move at maybe 5.5%, 5-6% in that neighborhood, 7-ish% by the end of the week. So if you're going to be trading the March 170s versus the April 180s, and NVIDIA is now, let's see where that closed for the day. $191.5, okay. So these are going to be, I'll just take a look at these and call them the 95%ers. And call these 90s. We'll look at them both for today. So what you are basically trading then, the 90%, so you're trading the red line for March. So that's going to be these ones right here. You're selling that implied vol, and you're going to be looking to buy the April. It's going to be these things right in here. So you're selling that vol, and you're buying that vol. So far, so good. Now, I also happen to have, let's take a look at what the average vol crush is. I think I have a mechanism to calculate this. Let's see if I can pull that up really quickly. So some of you may have seen what I did with Dom last week. And so this is actually using the options trade AI system for doing some of these calculations. And we can take a quick peek and scroll down because this usually reports the, there we go. So this is 16 quarters worth of vol crush. So 19% is kind of the average number. All right, so that is helpful context for us to have. So now we're just going to build these out. Let me take a quick peek. The moves have not been as big lately. What's the pattern been? The pattern has been NVIDIA comes out, they crush the number, raise guidance, right? That's essentially the pattern we've all become used to. But you'll also notice that NVIDIA has basically been dead money or close to it since the beginning of Q4 of 2025. So from basically October 1st or end of September through the end of December, the stock was literally unched. I mean, almost to the penny. And I say almost to the penny because I think it was down 4 basis points. 4 basis points over that period. So it was unched. Obviously, it's up a little bit now this year, but it still is underperforming, or at best, it's about a market perform. I happen to notice this because I was comparing it to the Yield Max options income strategies on NVIDIA. One is NVD, so that's NVDY, November VIC. Let's see, let me pull this thing up really quickly. I'm going to get this thing first, which actually has outperformed it by, I think 200 basis points, and INVIT, which is the target 25 as well. Now, I realize these are both puts. Give me a second. I'll switch them both over. So there you go. So this is essentially what that strategy is going to look like. Now, the thing to think about is, where is volatility going to go after earnings for these two? So to understand that a little bit better, what we can do is we can take a look at how this shifted the last time the company reported. So they reported, just want to make sure I have this right, November 19th. So we can now go over here and say, okay, I want to know what this looked like on the 20th of November. And I'm curious to see what it looked like on the 18th of November. And these were, let's take a look. So this was November expiration. So essentially what's going on here is you were selling effectively the 1 month option. So you were selling this one and buying out 2 months, which is probably this. Is that right? 1 month out. So that's this. So what we can see now is that fell by about 3, so 8%. And this fell by, well, it looks by about 10%. Okay? So now let's take a look at these options and see how that's going to translate. So on a standstill basis, how's that likely to look? Assuming, for the sake of argument, I don't know that this is true, but let me get, is this my actual Excel, or is this some, I don't think that's, that may seem confusing. How could it not be my Excel? But actually I wasn't sure whether it was my virtual work account or not. Okay, so now we're going to add these options in. So we had NVIDIA US 3/20/26 170 puts, and then the Aprils. And actually, I hope that I have those expirations right. Oops. I can blow this up a little bit. Okay. So this is So these are the closing mid prices for these. Now, let's assume, for the sake of argument, that the moves are comparable to what we saw the last time, right? So that means these fell about 5 clicks, and these fell 3. So we can see that on that basis, your standstill return one day would be, so let's assume you got this thing off today. You bought that today for this, and you sold it for that. April's put is the, oh. Yeah, I thought there was something wrong there. That's not going to work. Okay, so not including theta, if it behaved in about the same way. So what's going on here? So you are going to see a bigger vol crush in the Marches for sure. But the issue you have is that the vega for those options is less for 2 reasons. One, there's less time to expiration, but also they're further out of the money. Now, if NVIDIA drops, so what we're going to do is we're going to figure out we're going to approximate what the standstill return is. Okay. So these decay a little bit more rapidly. This is basically a push. It's really going to be more of a vega bet. There's only 2 days to go here. So you can see that the net theta on a standstill basis, and that would be assuming that the volatility didn't have an event in it. Because when there is an event, and that is a disproportionate percentage of an option's value, the theta can be not that representative. Why? Because the implied volatility of the March options is actually going to rise between now and tomorrow. So these are the implied volatilities at the midpoint. And the reason is because we have that event, right? So the event's going to stay there, and the underlying volatility process remains constant. So the implied volatility is actually going to bump up a little bit. What that means is that this theta is overstated. It's not likely going to lose the 15 cents on a standstill basis. So I guess what I would suggest is that, at least based on this analysis, if you are inclined to make a bearish bet on NVIDIA going into the print, if the underlying stays still, you're not risking a whole lot for a little bit of optionality, right? You're going to get a couple days worth of decay. The vol crush is actually not going to be a tailwind. You're not going to get a standstill rate of return in this particular instance, most likely. But you're also going to have offset the decay fairly nicely. So I think that it's a fine trade if you're bearish, right? And actually, I can't. So this one says probability of profit is 54%, which suggests, and it has a break even of 192.13. So options play is saying that this is actually going to have no cost on a standstill basis. The analysis we just did together suggests that actually there is a slight standstill cost, but it's mild, right? So NVIDIA ends right here after the earnings print. I see it as a small loser, but small. Relative to the value of NVIDIA, quite small. So, if you're inclined to make a bearish bet, I'll put it to you this way. It's going to have by my work, it's going to have a lower standstill cost than if you simply opened a March 180, 170 put spread. for those reasons. So what are we trying to figure out? We're trying to figure out the change in the value of these options for the passage of time, and we're trying to see, estimate. And by the way, if I was doing this in a more robust fashion, we'd model out what the changes in implied volatility would be a little bit more, rather than just saying, okay, what did it do last time? Will it do the same this time, and so on. But I wanted you guys to get a sense for how you can think about that. The other thing I would emphasize is that when you expand the amount of data that you look at, so when we were looking at the Options Trade AI platform to do that work, which, where did I put that? If I can bring that one back. Yeah, there. Why am I not seeing? Oh, here it is. Yeah. Okay, so here we are. By the way, we did select a few people for the beta trial. I haven't had an opportunity to connect with Vlad Furman or Dom on this. I did see an email that indicated that they might not be taking any more beta users. But if you're a regular viewer and you applied and didn't get a beta user login or something like that, and you are interested, it is in the description for the video where we had Dom, which was, I think, was either that was last Wednesday. So you'll see that in a link to the form to fill out if you're interested in the beta trial in the description to the video for Open Mic last Wednesday. You can apply there. The only thing that I know that we're asking for is that if you do sign up for a beta access, that means you're actually beta testing it. So we want people who have some experience trading options or at least looking at these things, and we want some feedback because we have quants and developers who are doing this, but they don't necessarily have the same perspective that people who are trading their own accounts might have on what makes something helpful or useful or not. So yeah, I just wanted to throw that in there while we're at it. And I was also curious to see what. Okay, so yeah, so this is interesting. It does appear that it has a number of credit spreads as potential as trades that have expected P&L, positive expected P&Ls with decent annualized returns estimated and good probability of profit there. Not all. So, not every one of the stress tests, though, is a total positive. So, for example, remember that there's 10 different models that are applied to each situation. And so when you get these reports, if you're one of the beta users who's doing it, you can hover over these things and you can see, which one of the tests has a negative expected P&L and how much that expected P&L is. So if you see a negative number there, so for example here we see long stress test expected profit loss of minus $294. Remember, this is not on a buy share basis, this is on a buy contract basis. Then it's just saying that in the worst case, based on that particular model's calculation, that would be the value. The expected P&L in general is an average effectively of all of these models' expectations and their respective probabilities. So yeah, just something to think about there. Okay, so Kirk Moz. Hello, Mike. When XYZ was at 53.22 on Friday, I was contemplating selling a straddle at the $57 strike for February 27th. That call and put premium would have put me up a little over break even. Let's see. And is this a good... Okay, so is this a good strategy to recover on the stock? My cost is $63.51 without premiums that I have received selling against the stock. Okay, so you own the stock at $63.51. You're thinking about selling a 57 straddle with the stock down 53.22. Okay, well, let's take a look at this. So the issue I have with selling a straddle Now, I like selling strangles against equity positions. There are a number of, I've referenced two of them. There's a couple hedge funds that are known to do this and have done this in the past. Leon Cooperman, former head of Goldman Sachs Asset Management, founder of Omega. Is it Omega Advisors? I don't remember. Omega Advisors or Asset Management, Investment Partners, I'm not sure. But Omega is the name of his big hedge fund. He was one of those people who, very, a sophisticated investor, but has a long-term buy-hold approach. The logic of selling strangles for him and also I think Pete Koppel over at Glenview. I don't even know whether he's still at it or not, but Glenview was another hedge fund that was known to do this kind of thing. The logic makes good sense. You're trying to capture the volatility risk premium. You're willing to acquire more of a stock that you like at a lower price, and there is some price at which a stock that you currently hold, you'd be willing to sell it. So do you want to supplement the anticipated returns of your long holdings by selling some options premium? That can make sense. Would you like to acquire a stock that you like, or acquire more of it, I should say, at a lower price? That too makes sense. Is there some price at which you'd be willing to sell it? That also makes sense. So it seems like a hat trick. Of course, the tricky bit is that in the short term, if you have a valuation of a stock, you buy a stock that's 80, you think it's worth 120. I mean, I think very few people with long-term holds buy stocks that they're so sure are worth 5% more than the current stock price. We never have that kind of resolution, I would say, usually in our valuation for businesses. We just simply establish that we think it's worth materially more than it is now. 5% this way or that is probably within the margin of error for our calculations. So the challenge when you're selling short-dated options is that, in general, to collect any kind of meaningful yield, the strikes are going to have to be relatively close to the stock price. So that valuation component isn't really going to play. So now we're going to modify this, and we're going to assume that you're actually long the stock. I'm not going to figure your break in even here. Did you mention? Okay, February 27th. All right, so we're going to add a call. We're going to add a put. We're going to sell both. We know that it was February. It's this week ending like this. And it was, you were looking at the 57s. Okay, so now look at what this trade looks like. What does that trade look like to you? It looks like a short put. And there's a reason why it looks like a short put. Because if you sell a straddle, you're selling a put. And if you own stock and you sell a call against it, you're selling a put. So really what you're doing is now you're short two puts, right? Okay. Now, does that make sense? And would the 57s make sense? Here's the issue, and that is if we go to this and you take a look at the calls, okay, so this is at the midpoint, those calls are collecting 80 cents of extrinsic value, right? Well, it's all extrinsic value because they're out of the money. Right? So 80 cents, which is 1.6% of the current stock price. Not bad. The 57s, now this is going to be a little bit trickier. So part of my question is, where can you get these things off? My guess is that, the bid-ask spread on those is going to be a little wider. So if you sold those things on the bid at 680, right? So 680 versus 57 stock gets us to 50.20. So you're collecting 57 cents of extrinsic value if you sold those on the bid. So the first thing I would say is you need to be careful about your execution, your limit orders, because there's a big difference in the percentage rate of return you're going to get if you sell these things somewhere in the middle, like 710 versus 680. I'm also going to say that selling them at 710 is unlikely. Why is it unlikely? Because there's a cost to carry for an in-the-money put from the market maker's point of view, it's de minimis. It only goes to Friday. But you're probably not going to get more extrinsic value from the put than you would for the call, unless there was a dividend. There's not. Doesn't really apply here. So consequently, you're not going to get those things off at 7.10. You are not going to get that much extrinsic premium. So if you can get 80 cents for the calls, or what is, 80 cents was the mid price. I don't even know that that's realistic. But maybe 75 cents of extrinsic for the calls, 70 perhaps for the puts. So now essentially you've doubled your downside risk, and you're going to be collecting, we'll call it somewhere in the middle, 72.5 cents per contract, essentially to be short puts on a $51 stock. So you're getting 1.4% in a week. Yeah, I'm not enamored of that as a recovery strategy. Instead, as a recovery strategy, well, there's two things you can do. One, you can just start selling covered calls against it and keep lowering your basis this way. That's one thing you can do. A more conventional stock recovery approach is, okay, the stock has fallen. I would like to be able to make more money on a more modest recovery than I would get, because maybe the stock is going to run into some resistance. Okay, so where's the resistance in this case? Well, this is saying 51.27, 82.5. But let me just illustrate this trade so we can kind of think about it. I'm going to bump the expiration up a little bit. All of these strategies that involve selling more options than you're long, I'm going to look out in that 30 to 45 day time frame, kind of taking, the Tom Sosnoff and Tony Batista tasty trade. I think J.J. Kinahan when he was at Thinkorswim, and then he was at Tasty, and I believe he's now at SIBO. But there has been a decent amount of work done that maybe this is kind of a sweet spot for most retail investors to look at in terms of expirations for selling premium, because you don't do this for a full-time job. You get a decent amount of theta. You're not short tons and tons of gamma, less trade management issues. But let's just take a peek. So what you might do instead is say, okay, well, I'm actually going to be willing to buy a call that expires, let's see. Let's just pick these. Maybe we'll pick the 50s. What the heck? Those are actually slightly in the money, but I'll use those. And then I'm going to sell 2 of some higher strike option like that. Let's see what you have now. Okay. So now what happens? Now the stock does not need to get back to your $63 purchase price, or wherever it is that you own it, call it $10 higher, for you to get back to scratch, because you're actually accelerating the gains that you're going to make from the current spot price up until you get to a little bit above that short strike, right? So in this case, you're going to enhance your returns. You're going to essentially, we're putting this thing on for a very small debit. Let's just assume for the purposes of just thinking about this conceptually, let's just assume we get this on at no cost. So the calls that you're selling are $2.35. The ones you're buying are about $5. So you're actually going to have a very slight debit. But if you put this on for even, the simple way to think about it is, between my long call strike and my short call strike, I'm going to essentially double my returns, because I'm going to make that if the stock rises. So from 50 to 57.5, I will make $7.50 on my long stock. I will also make $7.50 on my 1x2 call spread. So that's $15 of gains from $50. Again, we're just using $50 as sort of as a placeholder. If my basis was 63, that means that the max value of this whole package is 65. So I will never be selling the stock at a loss. Now, a $2 gain versus $63 basis, is that really great? It's not great. But the truth is, the reason people use strategies like this is because sometimes if a stock rolls over, you anticipate that the stock is going to encounter some resistance if and as it returns basically to the scene of the crime, as my friend and CNBC colleague Carter Worth would put it, creating some resistance there, which is the reason why you're willing to sell those calls, not expecting it to break straight through. Now, in that context, I would just offer that at least by the technical analysis that Options Play is doing right here, it doesn't really see much resistance to the upside once it gets through 82.5. Maybe we can look at this from another technical perspective. I'll pull up a chart. Maybe we can look at, what do we got here? So here's just some fib numbers. We can take a peek. I really should make it so that these grid lines don't show up because they really make this a little too noisy in my opinion. So we've got the 50-day at 62.2. We have this Fibonacci retracement level here at 58.8. So maybe that does make sense, like 50, 57.5. Selling a straddle doubles your exposure to the downside. And if you think that's worth it for 1.4% returns in a week, all I would say is that if it continues to decline, you're going to have to get that much more aggressive with your overriding program because you can't do that indefinitely unless you're Jerome Kerviel at SocGen. He was at SocGen, right? I'll ask somebody else to double check that. But if you don't know who I'm referring to, it was a guy who worked at, I believe it was SocGen. It was either SocGen or BNP. But effectively, he was essentially trading martingales on futures with the bank's capital. And at one point was up, I think well over $1 billion. He then continued to trade and things went the other way. So, okay. All right, James Forbin. Hey, Mike, can you discuss the pin risk for Micron calls and puts for February 27th? Let's see what we have. Do we have a lot of... Oh, I apologize because this is just going to be a sea of numbers here. Let's see where all this open interest is. So we have a lot of open interest on the 420 line, as you can see. 52,000 contracts. So that's where most of the concentration would be. Here, you know what? At least I think I have a better way to visualize this. So let's do this. Let's take a look at the open interest. And we're going to look at it for just this upcoming expiration. Okay. So what we're really interested in, if you think that a stock could potentially pin, the question you're asking yourself is there a huge amount of open interest around a specific strike? And the next question is, who holds that open interest? Because most retail and actually a lot of institutional buy-side accounts aren't trading gamma. What does that mean? That means that they're not trying to trade it delta neutral. So if the stock falls, that doesn't necessarily mean they're buying the stock through the strike. And if it rises through the strike, they're not necessarily trying to sell it. So you can imagine that we'll just come up with a really simple example. We'll say that Micron's trading $420 a share, which is approximately where it is. So we're looking at the 420 strike this coming Friday. Let's say, for the sake of argument, there's a huge amount of open interest on only the 420 strike and no other options. We'll say it's the position limit, 250,000 contracts, which means that there's effectively, that's 25 million shares worth, which is a lot, right? Because this is a $420 stock. So if the 250,000 contracts, we'll just make it call options for the sake of argument. If I'm a market maker and the stock rallies through 420, the calls that I own are now in the money, I have stock to sell. And as expiration approaches, the amount of stock I have to sell is going to approach a delta of 1 or 25 million shares. So I'm going to be selling the stock above the strike. Now, if it dips below the strike, what am I going to do? Well, if I'm short the stock, I have to buy that stock back. So now I become a buyer of 25 million shares. And what the net effect of that is it can act like a magnet, drawing the stock towards the strike, because the market making community, just as a natural byproduct of their hedging activity, are buying the stock lower, selling it higher, and that creates a huge market for the stock. Gamma increases as expiration approaches. Now, people will say that theoretically it becomes infinite. It does not become infinite because we know how much stock has to be bought or sold, right? If it's above 420, in the example I gave, it's 25 million. And if you were short that already and it drops below, then we know how much there is to buy. Also 25 million. It's not infinite, but it is a lot. And the closer you get to expiration, the more meaningful that is, because it's one thing to execute 25 million shares over the course of a month. It's another to do it over a week. It's another to do it over a day. And as we think about it, like in this kind of, is it converging towards, infinity? If you had to buy or sell 25 million shares of Micron within the last 15 minutes of the trading day, that's, more than the market's likely to be able to absorb. So you compress the stock to the strike, and that's what pinning is. That's what causes it. But there is, of course, a lot more to it than this, because we don't know for sure who owns what unless you've tracked every trade. And actually, you can take a look. I think I actually reached out to Unusual Whales. Hopefully we're going to get them on. I believe that they sort of keep track of this, but that's one of the things that you would be thinking about. So there is a lot of open interest there. So it is possible that it could converge to the strike if the open interest is largely in the hands of those who do hedge long gamma. Short gamma can have the opposite effect. So let's see. I have a 440, 460 vertical call credit spread on Micron. Should I close, hold, or roll? For Friday, I assume? Is that just for clarification? Let's take a look at what that is, how much that is. I'm assuming, James, that you are referring to Friday expiration. I'm not sure. $7.50. So 1.8% return with a probability of profit that is, close to 70%. I mean, I think it's actually a little bit better than 70%, probably. I think that's probably an okay trade to stay with. But I don't mind rolling it either. I mean, I kind of like the idea of selling. So actually, I'm glad you brought this up, because I rather like the idea of selling call credit spreads here as another way to sort of contend with the things that we were just talking about, which were these charts, right? So if you feel like valuations are getting stretched, one way to contend with that is to say that I don't think as much of my returns are going to come from in those highly appreciated stocks from continued capital appreciation. So I'm going to look to try to harvest a little bit more returns out of some of those positions by selling some upside against them. In the case of Micron, call credit spreads against a long position can certainly make sense, because just take a look at, the thing's just basically been a hockey stick, right? I mean, look at how this thing has done over the last 18 months or so. This thing was 61.54 back here. I mean, that's eightfold increase or whatever it is. It's sevenfold increase. That's just incredible. But it does feel like it's a little gassed. And some of the sort of NVIDIA feels that way a little bit to me as well. We'll find out whether they can once again blow the doors off numbers sufficiently that it catches a bid. But it's basically been dead money for 4.5 months. Okay. Let's see here. Oh, I've already gone over the hour. So Tucker D. Dog said, I think I saw an email in the description. You could try that. Tell them Mike sent you. Yeah. Yeah, there's an email. I think it's support at Options Trade AI or info at Options Trade AI. I think it's, yeah, let me look in the description. In fact, better than that, why don't I show you guys how you can go find out. You can go to the YouTube channel, which is youtube.com/openinterest. And you can go to the video. Which one was the one that I had Dom on? That was on the 18th, I think. Right? Was this the one? Yes. And here it is. So you just look at the description, and in here it says if you're interested, it says, so here's the form, HTTPS trade. Oh, producer's just telling me that the form is no longer there. So it would have to be the email, which is support at Options Trade AI. Yeah, the form, I guess they have already closed the window on the form. But if you send an email pleading your case to support at optionstradeai.com and say Mike said on his live stream that I could still have a chance, then the dev team, depending on their mood, might say, okay, we're gonna let you in. By the way, it's also worth noting that people who have signed up to do the beta testing but aren't actually beta testing, which means looking at it, playing with it, and reverting with feedback, which is critical for beta testing. That's the reason you do it in the first place. That they might just get kicked out of the trial, and that would open up slots to people who are willing to give it a legitimate chance and to give it some, and provide their insights. You don't have to be an expert to do this. In fact, it's probably good if there are people who have used sophisticated systems and they're lending their thoughts, as well as having people who've never used any systems sharing their thoughts, because, the whole idea is to make this a product that has the broadest possible appeal and utility to the broadest swath of investors, but does not have any learning curve. So the thing you'll notice about the platform that they've created is that you just get an email and it gives you trade ideas. And there are buttons you can drill in. So if you want to learn more about the quantitative work that got you there, you can learn more about it. And there are some things that you can also enter as well. But it's not supposed to be a platform that you need to use. It's an automated and updated quantitative report that gives trade ideas that you can apply on top of your own process. Okay, so with that, because I've already chewed up more than my allotted time, or of both mine and yours, I want to thank all of you for watching. As always, thank you for your questions. I really do appreciate it. Like, subscribe, notification bell, and we'll see you all. I think tomorrow we're going to be having office hours again with Mark Guthner. So thank all of you, as always, for watching. We'll see you soon.